Welcome to Talk Tickers. We're here to cut through the noise of earnings calls, and today we're jumping straight into Guaranty Bank shares, Q1 2025 results.
That's right. We'll give you the key takeaways, the stuff you really need to know from their latest report and call.
Okay, let's start with a snapshot. How did Guaranty actually do in Q1?
Overall, pretty solid. Net income landed at $8.6 million. That works out to 0.76 cents per basic share.
$1.76. How does that stack up?
Well, it's down a bit from the $0.88 they posted last quarter, Q4 24. But importantly, it's quite a jump up from the $0.58 they earned in Q1 of last year. So year-over-year growth is there.
Okay, decent year-over-year. What about the core profitability metrics?
Yeah, return on average assets was 1.13%, and return on average equity came in at 10.83%. Both respectable numbers for a bank.
And the all-important net interest margin, NIM.
That's actually a key positive story this quarter. It increased quite nicely to 3.7%.
Oh, well, up from
3.54% in the linked quarter and significantly up from 3.16% a year ago. So good expansion there.
Definitely a positive trend. Anything else in the quick summary? Dividends, buybacks?
Yep, they were active. They bought back some shares during the quarter, and they also increased the quarterly dividends slightly, up a cent to $1.25 per share.
Okay, good overview. So NIM expansion, solid returns, bit lower income linked quarter, but up year over year, and returning capital. Let's dig into the balance sheet now. Assets first.
Sure. Total assets nudged up slightly by about $37 million overall. Not a huge move.
What was moving underneath that?
The big swing was in cash. Cash balances jumped by almost $72 million.
The $72 million. Where did that come from?
Primarily from cash flows generated by their loans and securities portfolio, payments coming in, and also from an increase in deposits.
Okay, so cash is up. What about the earning assets, loans and securities?
Right. Those actually offset some of the cash buildup. Net loans decreased by about $23 million during the quarter.
Loan balance is down. Any color on that?
Management mentions slower borrower demand, possibly a link to uncertainty around tariffs and the general economic picture. However, and this is important, they said their loan pipeline for Q2 looks like the strongest it's been in 3 years.
Okay, so maybe a temporary dip with a rebound expected. Interesting. What about the securities portfolio?
That also decreased slightly, down about $7.2 million in total. They did buy some new available for sale securities, about $30.9 million worth.
Okay.
But that was outweighed by maturities, calls, and paydowns on existing holdings, which totaled about $31.5 million.
Makes sense. Any change in the unrealized loss position on those securities? That's been a focus for banks.
Yes, and it was positive news there. The unrealized loss on the available for sale, or AFS portfolio, improved. It decreased by roughly $6 million pre-tax.
Yep.
So the total unrealized loss on AFS is now down to $14.7 million.
That's a helpful improvement. Any other notable balance sheet items? Oh,
Yeah.
REO.
Yes. They sold their very last piece of REO, other real estate owned. It was a single-family home in the DFW market, carried at about $1.2 million. So that's off the books now.
Good to clear that out. So with all those moving parts, how did total equity fare?
Equity increased overall by $6.7 million. The biggest piece, naturally, was a net income of $8.6 million.
Right.
Then they got a boost from employees exercising stock options, about $1.3 million net effect there. And also that improvement in other comprehensive income, the AOCI, linked to the better unrealized gain-loss picture on securities that added $4.7 million.
Okay, so income options, AOCI improvement. What offset those gains?
The main offsets were the share repurchases, which used $5.2 million of capital, and the dividends paid out, totaling $2.8 million. So still a net positive build in equity.
Got it. Okay, let's shift from the balance sheet snapshot to the income statement flows.
Yeah.
We know net income, but tell us more about net interest income.
Yeah, as we touched on with the net interest income showed really good improvement, up compared to Q1 last year and also up compared to the linked quarter, Q4 24.
And the driver was primarily that margin expansion.
Exactly. It's the effect of assets like loans and securities repricing at higher rates following past Fed hikes, combined with managing their deposit costs effectively. They're earning more on assets relative to what they pay for funding.
Makes sense. What about the other side of revenue non-interest income?
That was actually down compared to Q4 by about $693,000.
Why have a decrease there?
A couple of main reasons. In Q4, they had some elevated rental income and also a gain from selling a different REO property in Austin. Those didn't repeat. Plus, in Q1, they booked a loss on the sale of that final DFW REO property we mentioned, about a $184,000 loss.
Okay, so some one-off items impacted the comparison. Anything else?
Yeah, service charges and gains on mortgage and SBA loans were also slightly lower just due to lower volumes in Q1. On the flip side, debit card income was actually up because of the timing of an annual bonus they get from MasterCard. It hit the books in Q1 this year, whereas last year it was recorded in Q2.
Okay, so a bit noisy on the non-interest income line due to timing and one-offs. How about expenses, non-interest expense?
The expenses were up compared to Q4 by about $1.3 million.
What drove that increase?
A big chunk, around $575,000, is seasonal. It's related to the annual funding of an executive incentive retirement plan and also some extra payroll taxes tied to year-end bonuses paid out. That typically hits in Q1.
Right, standard Q1 stuff for some companies.
Exactly. Another factor was that in Q4 last year, they had reversed some health expense accruals, about $446,000 worth. That benefit didn't repeat, making the Q1 expense look higher by comparison.
So mostly timing and seasonal factors driving the expense jump.
Largely, yes. Management did say they expect employee compensation and benefits costs to be lower and more consistent in the upcoming quarters.
And the efficiency ratio, where did that land?
Came in at 66.78% for the quarter.
Okay, so higher expenses, but with explanations and an expectation for normalization. Let's pivot to the loan portfolio again. We know balances dipped slightly. How's the credit quality holding up?
Credit quality looks very strong, actually. Non-performing assets, NPAs, as a percentage of total assets, stayed really low at just 0.15%.
15 basis points. Yeah, that's low.
And net charge-offs were also minimal, only 0.02% annualized for the quarter. Basically negligible.
Any movement in non-accruals?
They did tick up slightly to $4.8 million, but management noted this was mainly due to one single-family loan, which they described as well collateralized. Substandard loans were apparently pretty consistent with year-end levels.
And what about the loan loss provision with loans down slightly and credit stable?
They actually recorded a reverse provision for credit losses, so a credit to earnings of $300,000.
It's interesting, releasing reserves.
Yeah, driven by the slightly lower loan balances and the ongoing stable credit trends. Their overall allowance for credit losses, the ACL coverage ratio, is now 1.32% of total loans.
Still seems like a healthy coverage level.
It is. They mentioned that the qualitative factors they build into the allowance remain somewhat elevated, reflecting, ongoing economic uncertainties, things like tariffs, the election year, lingering effects from COVID and past bank failures. But they don't foresee needing to build reserves much from here unless some big systemic concern pops up.
Makes sense to stay a bit cautious. You mentioned the loan decrease was mainly C&I. Any more detail on the portfolio's nature? Yeah,
they highlighted the granularity. For example, their real estate construction loans, they have about 650 of them, and the average balance is only around $357,000.
Okay, pretty small average size.
Right. And for C&I loans, commercial and industrial, they have over 1,500 loans with an average balance of roughly $140,000. So it's spread out, not concentrated in huge loans.
That granularity is definitely a risk mitigator. Okay, let's talk funding and liquidity. How are deposits looking?
Deposits grew modestly, up $12.2 million overall in the quarter.
What types of deposits saw growth?
The growth came from money market and savings accounts, which were up about $19.6 million, and also demand deposits, DDAs, which grew by $11.5 million.
So core deposits growing. Any offsets?
Yes. CDs, certificates of deposit, actually decreased by about $18.9 million. So a bit of a mix shift there towards more core funding.
And the level of non-interest-bearing deposits?
Still quite healthy. They make up 31.3% of total deposits. That's valuable low-cost funding.
You mentioned granularity in loans. Is the deposit base similar?
Very much so. They highlighted having over 91,000 active accounts, and the average balance across those accounts is under $30,000. So again, very spread out. Uninsured deposits, if you exclude the guaranteed accounts they own, were about 26.7% of the total.
Okay, sounds like a stable, granular deposit base. What about overall liquidity?
Liquidity looks quite strong. The liquidity ratio was cited at 19.8%. And remember that cash balance jumped significantly to $217.8 million.
Right, plenty in cash on hand.
Plus, they expect another $116 million in cash flow just from maturing securities principal and interest payments by the end of this year. And their total contingent liquidity, like borrowing capacity, is around $1.3 billion. So they seem very well positioned from a liquidity standpoint.
Any plans for deploying that liquidity? Bond purchases?
They mentioned they plan to continue adding to the bond portfolio, but kind of cautiously, using a dollar cost averaging approach. They noted that recent bond market disruptions actually allowed them to pick up some securities at attractive levels. They still have about 5% of the balance sheet just sitting in Fed funds, which gives them flexibility.
Got it. And capital levels.
Capital looks robust too. Total equity to average assets was 10.5%, and the tangible common equity ratio, TCE, was 9.37%, well above regulatory minimums and providing a solid buffer.
And they were buying back stock as well.
Correct. They repurchased about 127,500 shares in Q1. That's roughly 1.1% of their outstanding shares. Management views buybacks as a good tool when the price looks right and they have excess capital. They said they aren't actively buying right now, but are ready to jump back in if conditions warrant.
Okay. So pulling this all together, what are the sort of key investor takeaways from this quarter?
I think there are a few main points. First, that net interest margin expansion is really significant, and the fact that they expect continued tailwinds from loans repricing higher and CDs potentially repricing lower is a major positive signal for future profitability.
Right. The NIM story seems key.
Definitely. Second, while Q1 loan growth was soft, blamed on that macro uncertainty, the commentary about the strong Q2 pipeline is encouraging. Something to watch closely, obviously depends on how things like tariffs play out.
Makes sense.
Third, their liquidity and capital are clearly very strong. This positions them well whether the economy accelerates or slows down, and it supports things like the buybacks and dividends. And finally, that ongoing focus on core deposit growth and keeping the loan book granular are real risk management strengths, especially, in today's somewhat uncertain environment. Plus, the buyback and dividend increase show management confidence.
All right. Excellent summary. Now let's transition to our favorite part. The This Is Not Financial Advice segment, where we brainstorm some, let's say, outrageous but plausible trade ideas based on what we've heard.
Okay, let's speculate a bit. Given that really strong outlook for net interest margin expansion at Guaranty, thanks to how their loans and CDs are set to reprice, one idea, maybe a bit contrarian given the Q1 loan dip, could be simply taking a long position in Guaranty Bank shares, GNTY.
Logic being?
The logic is that the market might be overly focused on the temporary loan slowdown caused by macro jitters, potentially undervaluing the stock. Meanwhile, that underlying NIM strength is set to really juice profitability, which could force a re-rating higher down the line.
Okay, a straight long play based on underestimated NIM power. Plausible, if maybe not totally outrageous. Got another one.
How about this? Playing off their commentary about buying bonds opportunistically during volatility. Maybe a paired trade. You could go long a hand-picked basket of other regional banks, maybe ones with less stellar deposit franchises or NIM outlooks.
Okay. And short.
And simultaneously go short a comparable dollar amount of a regional bank ETF, one that includes Guaranty Bank shares. The idea is you're betting on Guaranty's relative outperformance, driven by its superior NIM prospects compared to the average bank in the ETF as this rate cycle plays out.
A relative value play. Trying to isolate Guaranty's potential strength against its peers. That's definitely a bit more complex, but I see the angle. Wild, yet plausible perhaps. And of course.
Absolutely. Purely speculative ideas. Definitely not financial advice. Do your own homework.
Couldn't have said it better myself. All right, that brings us to the end of our deep dive into the Guaranty Bank Shares Q1 2025 earnings call. We've unpacked the numbers, explored the commentary, and even tossed around a couple of wild ideas.
Hopefully, this gives you a much clearer picture of where they stand and what the key drivers are moving forward.
Our goal is always to sift through the details and pull out what truly matters. Let us know what you found interesting. You can typically find recordings like this one on the investor relations section of company websites, like GNGT.com.
Thanks for tuning in to Talk Tickers.